Hi, thanks for joining me again. I had a question today on YouTube asking about a trap up move, and I explained in writing what it was all about, but I've got some spare time, so I thought I'd make a little video explaining it a little more deeply. Now, a trap up move is a sign of potential weakness, and as usual, subsequent price action is needed to confirm it as a true sign of weakness or not. Sometimes you might get what looks like a trap up move, but you don't get confirmation. The subsequent price action doesn't suggest it to be so. And then you have to ignore your consideration and just move along with the price action as it unfolds. Now, officially, a trap up move is an indicator that's made up of a combination of two bars. It's effectively a two-bar upthrust, or a variation on a two-bar reversal. There's a two-bar reversal here, and this is a trap up move. Very similar, it's just a variation of the two, and effectively it's just a two-bar upthrust of some kind. Remembering, of course, that an upthrust is a confirming or secondary indicator of primary weakness, and when an upthrust occurs on very high volume, it can be considered as a primary sign of weakness in itself. So if you've got some sort of supply bar after the price action has been, say, trending higher, and then as price continues on, you get some upthrust bars like this, then they're confirming the weakness that came in over here. If you get a really high volume upthrust, say volumes are like this, and you get a really high volume upthrust, and the next bar is down in response, then this bar can be considered a primary sign of weakness in itself. So generally, an upthrust confirms previous weakness, but on really high volume, it can be the weakness in itself. So back to trap up move. A trap up move can occur naturally or organically in a market, but more likely I tend to find them associated with futures markets and foreign exchange markets, where the big professionals play a big part in the market. And also in speculative stocks, like small mining stocks, where active professionals or speculative professionals are taking part. Now, the first bar of a trap up move is an up bar with average to wide spread closing off its highs a little, sometimes even closer to the mid bar. So here you've got a two-bar reversal, and they normally close quite high on the bar for the initial up bar. And the trap up move usually closes a little off its high, and that is what distinguishes them apart from each other. That's the main thing. And volume's usually quite high on the initial up bar. The second bar will usually move up initially and challenge the highs of the previous bar. Textbook fashion would suggest that it actually trades slightly above the high of the initial up bar, but that's not always the case. You'll get them sometimes like this, where price has moved higher, but it hasn't challenged the previous highs at all. The second bar, however, will always eventually close poorly down near the lows of the bar. And in textbook style, it would close below the low of the initial up bar. It doesn't have to, though. You can see in this case here, price has challenged the lows, but popped back up and closed just above the lows within the range of the initial up bar. This would suggest a market that's actually a little stronger and it's attempting to hold on. It might even hold on. You just have to wait for the subsequent price action to see what actually happens. But in this case, the bar did not close below the low of the previous bar, and the market is showing a little more strength than might have been expected. Now, volume's normally still elevated on the down bar, but it will usually be a little bit lower than the volume on the up bar. And on that note, just be careful if you get really high volume on the down bar, excessively high volume, that could actually be buying support come in. And if the subsequent price action doesn't help to confirm a trap up move or a reversal of some sort, and instead the market has taken advantage of the down bar's weakness and moved in and bought it up, you may get a reversal in the opposite direction. So excessive volume on the down bar, you need to be aware that the market may have changed its behaviour immediately. So just be aware of that. Now, this is generally a 2-bar combination, but don't hold that to be completely true all the time. And that's for all these market indicators. Sometimes these combination of bars can take place in more than 2 bars. So you can see here on this one, it's very close to the same thing, but it's just taken 3 bars to complete. You've got your initial up bar that's closed off its highs. The second bar is closed above the high of the previous bar. It doesn't have to, but it's textbook fashion if it does. But then there's been 2 bars to go down, and price has closed below the low of the initial up bar. It's just a 3-bar combination. It's just as valid, and you need to be aware that volumes may be a little different. You'll get very high volume on the up bar like expected, and you may get 2 smaller amounts of volume on the subsequent 2 bars. But just be aware that even though it's called a 2-bar combination, whether it be a 2-bar reversal or a trap up move, these things can take place over varying amount of bars. It's only the textbook fashion that happens over 2 perfect bars. So in the real world, you don't always get the textbook example of the principle you're looking at. The real world's a bit different. And here you've got a 4-bar combination. Same sort of thing. You can see now how it takes place. And if I just make an example here, just take note of these 2 shapes. You'll see them a lot in the market. This is a classic shape of a distribution pattern, an up bar, and there'll be supply going into the demand that's in the market and selling to the demand. Then you have 2 narrow spread bars where distribution takes place, selling takes place, and then a down bar that closes generally below the low of the up bar. And down here we have the mirror image opposite, where you've got an accumulation pattern. This is the shape of an accumulation pattern. A down bar that has quite good volume and buying in it. Then you have 2 subsequent bars with a narrower spread, and that narrower spread's because buying has come in, and then an up bar to complete it, and it closes above the high of the initial down bar. This is a distribution pattern. This is an accumulation pattern. It may take more bars than these 4 bars. It may take 10 bars, 6 bars, 12 bars. And it may happen in any time frame. 5-minute chart, 1 month chart. But this is the pattern. This is the shape. Up, across, down, down, across, up. Distribution, accumulation. You see it all the time. Okay. Now, Let's have another example. When you're looking for a trap up move or a reversal of some sort, you'll generally find that it begins with a market that's been trending higher, and then you'll see the sign of weakness come in, a supply bar of some sort, and then the down bar, which is trapping everybody into a bad position. The trap up move is so called because it encourages people to come in and buy because the market is going to go much higher, and the professionals are selling into the demand, trapping the buyers in the up move. That's what it's all about. Now, I've made this example with a gap up here, and that's really quite common. Whenever you see a gap, it's generally for a reason. They rarely, if ever, happen for no reason. Sometimes on announcement, but generally a gap will take place for a reason, and in this case it's to encourage buyers to stay in and get into the market because it's going to go to the moon. And you'll probably find that news is great and this market is just going to skyrocket higher. And on all that demand that's created by the news and the gap up and the widespread up bar on very high volume, the professionals are selling into the demand that's created. And although it closes off its high for the day, it'll often go up the next day because after the market's closed, the talk is still that this market is going higher, and at the open it tries to go higher, and that's why it goes above the highs of the previous bar. That's very common. But as the selling pressure gets greater, it forces price down, and that's why it closes low. And if it closes below the low of the up bar, that's a sure sign that serious selling pressure has come in. And you'll generally find that volume is still high, but it won't necessarily be as high as the previous bar's volume. You'll often see a down bar in response. That's an initial confirmation of the weakness that's been seen in the two previous bars. And you can see in my example here, I've got a test as the next bar, and there's no supply, because generally this will come about at the beginning of a period of selling. So in my example here, the market doesn't necessarily go straight down, it goes sideways into a sideways trading range where further supply takes place. This is where the professionals finish their selling. So quite often the trap up move is the beginning of a period of selling after the market's been in an uptrend for a period of time. And you'll see in response upthrusty sort of bars, little mini ones that attempt to go higher and fail, and you have no demand bars. You can see these little upthrusty bars here are confirming the weakness we've seen over here, and the no demand bar, an up bar with a narrow spread close in the middle or low. On low volume, the buyers are becoming exhausted. There's no buying pressure in the market anymore. These are confirming the weakness that's happened over here. That's why they're confirming indicators, or I call them confirming secondary indicators of primary weakness. And that's what's happening over here. Same with a normal test bar, sort of like this. When you see it in a sideways range, that's an accumulation range. They're secondary indicators of primary strength. You'll have buying in the background, and the repeated testing as price goes sideways is confirming the buying you saw at the beginning of the sideways trading range. So it's all got exact opposites. And this is a distribution pattern, and you'll see testing and shakeouts in a accumulation pattern. But eventually the selling has finished, and often you'll see some shorts being set at this point as well in larger stocks or in futures markets or forex. And then the final confirmation is some form of breakdown bar. A breakdown bar always has a wide spread trapping anyone who bought in here into a losing position. It's broken below the lows of the range with a wide spread and an increase in volume. You'll nearly always see a breakdown bar take this form. It's what it looks like. Now, from here, price could just have a shallow pullback and then some form of reaccumulation take place. That sometimes happens. Or you might get a new downtrend start where price continues lower for a repeated period of time and you get a deep pullback that's sustained over a long period of time before some sort of buying pressure comes in and you get a new accumulation begin. So what you get subsequently can vary, but generally what you'll see is a breakdown bar in the end. Now that'll either come immediately here, straight after you've seen the weakness, or there'll be a period of selling, and this will be seen with these confirming indicators of previous weakness. In this case, I've got some little up thrusts and I've got a no demand bar. And you should also note, I'll just draw that in quickly again. When you're looking at this sort of situation occur, you can see down here that pretty good volumes are still going through. This is all pretty good volume, and not dissimilar to the volumes that were taking place here when price was trending higher. But price has moved sideways now, and there's good volume still going through. Sure, you've got no demand here on low volume, but there is still good volume going through. But price is only able to move sideways. This is a telltale sign that something different has happened in the market. It's a change in behaviour. And you might have seen my video on looking at what has not happened in the market. Look at what hasn't happened. The market hasn't continued higher on good volume here. That's got to be a telltale sign that there's weakness coming to the market, most likely here. Good volumes going through, there's an inability of the market to continue higher at all. It's just gone dead sideways. Sometimes you'll see them going slightly lower. You'll see it like this. It won't be steeply lower, but it'll be angled lower. And that's because there's selling pressure in the market. That's the professionals who began their selling over here. Every time the market tries to go higher, they're selling into the demand. Each time, market tries to go higher, market tries to go higher, and they're selling into the demand. They're stopping the market moving high because they're selling into it. So looking at what didn't happen is really helpful. Good volumes going through, the market can't go higher. So even if you didn't work out that this was weakness, and this is confirming it, once you can see that the market has still got good volume going through and volume still high or high enough to support higher prices, you then have to think something's going on here. You need to work it out, hopefully before you get trapped into buying, and then a breakdown bar like this occurs and locks you into a losing position. So you need to always be aware of what's happening in the market and look at what didn't happen sometimes. And if something didn't happen, think about why it hasn't happened, and you may work out what is actually happening. Okay, hopefully that was helpful, and you can see what a trap up move is, why it occurs, and what happens in response. If anyone's got any other indicators they'd like explained in more detail, let me know in the comments. Thanks for your time again. See ya.